Stop scrolling. Close that tab where you're checking copper ETF prices. Turn off the financial news. Because what I'm about to tell you changes everything you think you know about the global supply chain. America isn't just buying copper anymore. They're weaponizing scarcity. They're building the largest strategic metal fortress in modern history. And if this is true, the system cannot go back. Ladies and gentlemen, what happened in the last 72 hours represents the most aggressive resource grab since the oil embargo of 1973. But this time, it's not about energy. It's about the one metal that powers everything from your phone charger to the AI servers processing this video. And the country that controls copper supply controls the future of technology itself. Here's what everyone thinks is happening. They think America is simply stockpiling copper because of potential tariffs. Smart hedging, reasonable preparation, business as usual in uncertain times. The mainstream narrative suggests this is temporary market positioning ahead of policy changes, nothing more than prudent supply chain management. That narrative is incomplete and dangerously naive. Because while financial media focuses on Trump's tariff threats and Chinese demand fluctuations, something far more calculated is occurring behind closed doors. The United States isn't stockpiling copper, they're monopolizing it. This isn't defensive positioning, this is offensive strategy. Let me walk you through what actually happened in the copper markets over the past month. The numbers are staggering, and they tell a story that nobody wants to acknowledge. CME warehouse totals have exploded to over 453,000 tons. That's not just a record. That's higher than the previous peak by nearly 100,000 tons. But here's the part that should terrify every manufacturing executive outside America. These stockpiles aren't sitting in registered warehouses where they can easily re-enter global markets. They're being moved to undisclosed private locations across the United States. Translation: America is taking physical copper off the global market, permanently. The mechanism is elegant in its simplicity. U.S. importers are front-running potential tariffs by buying massive quantities of refined copper from Chile, Canada, and Peru. But instead of using this metal for immediate industrial purposes, they're storing it, creating artificial scarcity in global markets while building domestic abundance. This strategy serves multiple objectives simultaneously. It reduces America's dependence on foreign copper supplies. It increases global copper prices, making American mining operations more profitable. And most importantly, it gives the United States unprecedented leverage over countries that depend on copper imports for their industrial base. China consumes roughly half of global copper production. Europe's renewable energy transition depends entirely on copper availability. Without access to steady copper supplies, both regions face industrial paralysis within months. America understands this dependency, and they're exploiting it. But here's where the narrative becomes more complex than simple resource nationalism. Because the entity driving this copper accumulation isn't primarily the U.S. government. It's private capital working in coordination with policy objectives. Investment funds, commodity trading houses, and strategic materials companies have collectively moved over $15 billion into physical copper positions since November. This isn't speculation. This is coordinated infrastructure building disguised as market activity. The timing reveals the strategy. These massive copper purchases began accelerating immediately after the election results became clear, but before any tariff announcements were made. That suggests the accumulation strategy was planned in advance, not reactive to policy developments. Someone knew what was coming, and they positioned accordingly. Now let's examine the global consequences of this copper capture strategy. Because while America builds its metal fortress, the rest of the world faces a supply crisis that threatens to destabilize entire industries. Copper prices have surged beyond $13,000 per ton for the first time in history. That's a 52% increase from early 2025 levels. But price increases are only the beginning of the disruption. Manufacturing companies across Europe and Asia are reporting unprecedented delays in securing copper supply contracts. Solar panel manufacturers in Germany are reducing production targets. Electric vehicle companies in South Korea are redesigning components to use alternative materials. Chinese electronics manufacturers are paying premiums of 30% above London Metal Exchange prices just to secure basic copper wire. This is not volatility. This is systematic resource strangulation. The artificial scarcity created by American hoarding is forcing global industries to make impossible choices. Accept dramatically higher input costs and pass them to consumers, or scale back production and surrender market share to American competitors who have guaranteed copper access. Either choice weakens non-American industrial capacity relative to American manufacturing, which is precisely the intended outcome. But the most disturbing aspect of this strategy isn't its economic impact. It's the precedent it establishes for resource control in an interconnected global economy. If America can successfully monopolize copper supply through private market mechanisms, what prevents similar strategies with lithium, rare earth elements, or semiconductor materials? The infrastructure for resource weaponization is being built right now, hidden behind legitimate market activity. Central banks worldwide are paying attention. They see a major power using financial markets to control physical resources essential for industrial development. The response is predictable. They're diversifying away from dollar-denominated assets and into physical commodities. Gold purchases by central banks reached record levels in 2025, not because they expect inflation, but because they recognize that access to physical resources may become more important than access to financial assets. Paper promises become worthless if the underlying materials are controlled by hostile powers. This creates a feedback loop that accelerates American resource accumulation. As other countries buy gold and reduce dollar reserves, dollar strength declines. Weaker dollars make commodity purchases cheaper for American entities, enabling even more aggressive hoarding. The system is eating itself, and America positioned itself at the top of the food chain. Here's the part nobody is pricing in correctly. The copper shortage isn't temporary, it's structural. Mine production growth has stagnated globally. Major copper mines in Chile, Indonesia, and the Democratic Republic of Congo have suffered serious accidents and operational disruptions throughout 2025. New mine development requires 5 to 10 years from discovery to production. There is no short-term supply response possible. Meanwhile, demand from artificial intelligence infrastructure is exploding exponentially. Data centers require up to 10 times more copper per unit than traditional facilities. The AI boom that everyone celebrates is creating copper demand that simply cannot be satisfied with existing supply chains. American tech companies understand this math. They're securing copper access now because they know scarcity is inevitable. But they're not just buying for their own needs. They're buying to ensure competitors cannot access supply. Tesla, Google, Microsoft, and Amazon have quietly established copper supply agreements that extend years into the future. These contracts lock up hundreds of thousands of tons of copper production from American and allied mining operations. European and Asian tech companies trying to compete in AI infrastructure are discovering that copper supply is no longer available at any reasonable price. This isn't market competition. This is resource elimination. The geopolitical implications extend far beyond technology markets. Countries that cannot secure adequate copper supplies cannot participate in the energy transition. They cannot build renewable energy infrastructure. They cannot manufacture electric vehicles. They remain dependent on fossil fuel imports controlled by other powers. Energy independence becomes impossible without copper independence. And copper independence is being systematically eliminated from most of the world. But here's where the strategy reveals its most dangerous dimension. Because copper hoarding is creating the conditions for international conflict over resource access. China has already begun restricting exports of processed metals and rare earth elements in response to American copper accumulation. Europe is discussing strategic material partnerships with Latin American countries to bypass American control. Russia is offering preferential resource access to countries willing to trade outside dollar-denominated markets. The global economy is fragmenting along resource access lines. Trade relationships are being restructured based on physical material flows rather than financial arrangements. This is the beginning of resource block formation that could persist for decades. Military strategists call this economic warfare through supply chain control. It's more effective than traditional sanctions because it targets the physical infrastructure of modern economies rather than just financial flows. And unlike financial sanctions, resource control cannot be circumvented through alternative payment systems or cryptocurrency. You cannot mine copper that doesn't exist. You cannot substitute materials that aren't available. Physical scarcity creates absolute dependency. American policymakers understand this power. They're using it. Now let's discuss what this means for investors and individuals watching these developments unfold. Because while governments compete for resource control, financial markets are repricing entire sectors based on supply access. Copper-intensive industries outside America face systematic margin compression. Their input costs are rising faster than they can increase prices. European renewable energy companies, Asian electronics manufacturers, and Chinese electric vehicle producers all face the same fundamental challenge. Their business models assume copper availability that no longer exists at reasonable prices. Meanwhile, American copper miners and metal processors are experiencing unprecedented profitability. Higher global prices combined with domestic supply security creates ideal conditions for margin expansion. Companies like Freeport-McMoRan, Southern Copper, and specialized copper recyclers are generating returns that have not been seen since the commodity supercycle of the early 2000s. But the real winners aren't the mining companies. They're the entities that control copper stockpiles accumulated before the shortage became obvious to financial markets. Investment funds that purchased physical copper in warehouse facilities throughout 2025 are sitting on unrealized gains approaching 50%. But more importantly, they're holding assets that provide leverage over industrial supply chains worth trillions of dollars. This isn't speculation anymore, it's economic statecraft. The Federal Reserve faces an impossible dilemma because of these dynamics. Copper price increases feed directly into inflation measures, but they cannot be addressed through traditional monetary policy. Raising interest rates cannot increase copper mine production. Lowering rates would weaken the dollar and make resource accumulation even more attractive for American entities. They're trapped between conflicting objectives, controlling inflation or maintaining resource advantage. The choice they make determines whether America continues building its metal fortress or allows global markets to rebalance through higher interest rates and stronger dollar policy. Early indicators suggest they're choosing resource advantage over inflation control. Federal Reserve communications consistently emphasize strategic materials and supply chain resilience over traditional price stability metrics. That's a fundamental shift in central banking priorities. Market participants who understand this shift are positioning accordingly. They're not buying financial assets that depend on stable inflation expectations. They're buying physical assets that benefit from resource scarcity and strategic hoarding. The investment implications go beyond copper itself. Industries that can substitute away from copper usage gain competitive advantage over industries that cannot. Companies with secure supply chains outperform competitors dependent on spot markets. Businesses located in resource-rich countries have structural advantages over businesses in resource-poor regions. This is portfolio rebalancing at a civilizational level. But individual investors face challenges accessing these trends directly. Physical copper is expensive to store and difficult to trade. Copper ETFs may not provide exposure to the scarcity premium if their metal is located in regions without supply security. Mining stocks offer leverage, but depend on operational execution and political risk. The clearest investment thesis focuses on American companies with secured copper supply chains and global competitors dependent on vulnerable access. The spread between these two categories will widen as resource competition intensifies. However, the most important decision for individuals isn't investment allocation, it's geographic positioning. Because resource control creates winners and losers, not just among companies, but among entire populations. Citizens of countries with resource security will experience different economic conditions than citizens of countries facing resource dependency. The copper shortage is a preview of broader resource competition that will define the next decade. Countries that control critical materials will maintain industrial capacity and technological advancement. Countries that depend on resource imports will face systematic disadvantages that compound over time. This isn't temporary market disruption. This is permanent restructuring of global economic relationships based on physical resource control rather than financial arrangements. The implications extend to individual living standards, employment opportunities, and economic mobility. If your country cannot access copper, it cannot participate in the industries that will drive future growth. If it cannot participate in those industries, its citizens face relative impoverishment compared to resource-secure populations. That reality should inform personal decisions about career development, business investment, and family planning over the next decade. America's copper hoarding strategy represents more than commodity speculation. It's the opening move in a broader campaign to control the physical resources essential for 21st century economic development. Other powers are responding with their own resource accumulation strategies, creating feedback loops that accelerate scarcity and intensify competition. The global shortage warning isn't just about copper prices. It's about the fundamental reorganization of economic relationships based on resource access rather than comparative advantage. That reorganization has already begun. The only question is whether you recognize it early enough to position appropriately. The copper fortress is built, the global shortage is real, and the future belongs to whoever controls the materials that power modern civilization. The copper fortress is built, the global shortage is real, and the future belongs to whoever controls the materials that power modern civilization. Now, let me show you the specific timeline of how this crisis accelerates. Understanding this sequence allows you to position before each disruption becomes obvious to markets. Phase 1, industrial rationing. Within 60 days, major manufacturers outside America will announce production cuts attributed to supply chain optimization. European automotive manufacturers are redesigning vehicles to reduce copper content. Chinese appliance companies switch to aluminum wiring despite performance disadvantages. Japanese electronics firms extend product life cycles to minimize copper requirements. Phase 2, price explosion. Between March and June 2026, copper breaks through $15,000 per ton. Not gradual appreciation, a gap opening caused by supply failure or trade disruption, eliminating significant capacity. Phase 3, currency crisis. Higher copper prices feed into inflation calculations for every major economy except the United States. America's stockpiles insulate domestic prices from global disruptions, creating artificial stability that strengthens dollar demand. Phase 4, diplomatic warfare. By late 2026, resource competition transitions to explicit confrontation. China demands international intervention against American hoarding. European Union threatens retaliatory measures. Traditional allies choose sides based on resource access. The copper success creates blueprint for systematic resource control, driving investment toward physical assets and away from financial instruments. Bond markets from resource-poor countries trade at yield premiums compared to resource-rich nations. Credit agencies incorporate strategic resource access as fundamental sovereign risk factors. American technology companies are quietly establishing manufacturing in regions with guaranteed copper access. Tesla expands exclusively near mining operations. Apple shifts assembly from China toward Mexico and Canada. Google and Microsoft build data centers where electrical infrastructure can be supported by secure supplies. Meanwhile, international competitors face systematic disadvantages. German automotive companies cannot guarantee copper access for electric vehicles beyond 2027. South Korean electronics manufacturers reduce R&D investment because they cannot secure materials for scaling technologies. This is industrial capacity elimination through resource control. The strategy creates irreversible advantages because copper-intensive infrastructure cannot be quickly relocated. Investment capital flows toward resource security, creating self-reinforcing advantages lasting decades. Central banks reveal desperation through emergency responses. Germany's Bundesbank initiates strategic metal reserves discussions. Bank of England issues confidential assessments warning about systemic resource access risks, destabilizing UK manufacturing within 18 months. The psychological impact extends beyond direct copper exposure. If America can monopolize copper through market mechanisms, similar strategies will target lithium, rare earths, silver, and platinum. Speculative capital front-runs these possibilities, bidding up entire material sectors. Individual investors discover retirement accounts concentrated in industries facing systematic resource disadvantages. Real estate in regions dependent on copper imports loses value as industrial capacity relocates to resource-secure areas. Traditional invest globally for diversification advice becomes counterproductive when resources are controlled by specific regions. Portfolio construction requires understanding resource control patterns rather than financial performance metrics. This is the new reality. Resource access determines asset values more than earnings or monetary policy. The Copper Fortress demonstrates how physical control translates into financial dominance across global markets. America's strategy succeeds because it combines private market mechanisms with strategic objectives. Other countries cannot replicate this approach because they lack both financial capital and institutional coordination necessary for large-scale resource accumulation. The game is over before most players recognized it began. The future belongs to whoever controls copper, and that future is being determined right now. But let me show you the specific mechanism that makes this strategy unbeatable. It's not just about buying copper, it's about controlling the entire supply chain ecosystem in ways that create permanent dependency. American entities aren't just accumulating refined copper, they're securing exclusive relationships with mining operations, refining facilities, transportation networks, and storage infrastructure. When you control every step from extraction to delivery, you determine availability. Freeport-McMoRan has negotiated supply agreements with American technology companies extending through 2030. These contracts guarantee delivery priority, regardless of global market conditions. European and Asian competitors discover their offers are irrelevant because metal is already committed to American buyers. The transportation infrastructure is equally controlled. American logistics companies have secured exclusive shipping contracts with major copper producers. When global demand spikes, these arrangements ensure American buyers receive delivery priority, while international competitors face months-long delays. American commodity trading houses provide credit facilities to mining operations worldwide, but these loans include clauses giving American entities first right of refusal on copper output. Mining companies accepting this financing effectively surrender production control to American buyers. This creates a global copper supply chain that appears competitive, but operates as an integrated American resource acquisition system. Individual transactions look like normal market activity, but the cumulative effect is systematic control over global copper availability. The legal framework supporting this strategy exploits international trade law in ways that make retaliation nearly impossible. American entities are not violating trade agreements. They are exercising contractual rights, negotiated through private commercial arrangements. When European governments complain about copper access difficulties, American officials correctly point out that no export restrictions exist. Supply constraints result from private market decisions, not government policy. This legal immunity makes the strategy particularly powerful because it cannot be addressed through traditional diplomatic responses. American companies have spent over $50 billion constructing specialized storage facilities and processing capacity designed specifically for strategic copper accumulation. These facilities represent permanent infrastructure dedicated to American resource control that will operate for decades. Meanwhile, countries dependent on copper imports discover their infrastructure becomes increasingly vulnerable. Artificial intelligence systems deployed for copper supply chain optimization provide American buyers with information advantages that make competitive bidding impossible. When algorithms can predict demand spikes weeks before they occur, American buyers secure supplies before competitors recognize opportunities exist. The cumulative effect creates what military strategists call strategic depth in copper markets. American entities operate with multiple layers of protection that make their resource control position nearly unassailable. When mainstream recognition occurs, policy responses will be desperate and largely ineffective because physical infrastructure for alternative copper supply chains requires years to develop and billions in investment that most countries cannot afford while facing immediate economic pressures. The Copper Fortress demonstrates how resource control can be achieved through private market mechanisms operating faster than government policy initiatives. Other critical materials will face similar strategies as American entities apply lessons learned from copper accumulation to lithium and rare earth elements. This is the future of resource competition: physical control through financial mechanisms, legal immunity through private contracts, and strategic advantage through systematic supply chain dominance. The shortage warning represents the beginning of this new era, not temporary market disruption. Understanding this transition determines whether you position correctly for the resource-controlled future or become another casualty of systematic supply chain weaponization. The Copper Fortress is complete. Global shortage is inevitable, and the future belongs to whoever controls the materials that power civilization.